Most people either have no insurance or they have the wrong kind, a policy that mixes investing and insurance together, sold to them as the smart choice, when it's actually neither a good investment nor good insurance. In this video, we are fixing that. I'll show you exactly how much health cover and term cover you actually need in India, whether a family floater or individual policy makes sense for your situation, and why term insurance beats ULIPs for almost everyone, with the actual math to back it up. Quick reminder from the last video: your emergency fund is the foundation, insurance is the wall around it. Without adequate health and term cover, one hospitalization or one lost income can wipe out years of saving and investing in a single event. So, before we talk mutual funds or SIPs, this has to be in place. Health insurance needs in India come down to three factors: where you live, your family size, and what your employer already covers. City tier matters because treatment costs vary massively. A single major surgery or extended ICU stay can run 5 to 10 lakh rupees in a metro and less in smaller cities, but even smaller cities are catching up fast. As a baseline, metro city, individual to 10 to 15 lakh rupees cover. Metro city, family of 4 to 15 to 25 lakh rupees cover. Tier 2/3 city, individual or family to 5 to 10 lakh rupees cover. And here's the part people miss: your employer health cover is not enough on its own. It usually caps out around 3 to 5 lakh rupees, disappears the moment you switch or lose your job, and often excludes parents or has weak maternity terms. Treat it as a bonus layer, not your primary cover. You need your own independent policy, regardless of what your employer provides. Once you know your number, the next decision is structure: one floater policy covering the whole family, or separate individual policies for each member. A family floater pools the total cover, say 20 lakh rupees, across everyone on the policy. Premiums are usually lower than buying separate policies, and it's simpler to manage. But there's a catch: if one family member has a major claim, the shared pool shrinks for everyone else that policy year. Individual policies give each person their own dedicated cover. Nobody's claim eats into anyone else's. This matters more as family members age, especially parents, since premiums for older individuals rise steeply and get expensive to bundle in with younger, healthier members. Practical rule of thumb: a floater works well for you, your spouse, and young kids, everyone in a similar age and risk bracket. But for parents, especially anyone over 55 to 60, buy a separate individual policy or a senior citizen plan. Bundling parents into a family floater is one of the most common and costly mistakes people make. It inflates the whole family's premium and puts everyone's cover at risk if a parent has a major claim. One efficient way to get high cover without a high premium: buy a smaller base policy, say 5 lakh rupees, and stack a super top up policy on top for another 15 to 20 lakh rupees. Super top ups kick in once you cross a deductible threshold, and they are significantly cheaper per lakh of cover than simply buying a bigger base policy. It's a cost efficient way to get to that 20 lakh plus number without paying 20 lakh policy prices. That covers health. Now let's talk about the other pillar: term insurance. Because health cover protects your money, but term cover protects your family's future if you're not there to earn it. The old rule of 10 times your annual income is outdated and usually too low. Use this instead: the human life value method. Start with your annual income, multiply it by 15 to 20 depending on your age and how many working years you have left. Younger earners need a higher multiplier since there are more years of income to replace. Then add your outstanding liabilities, home loan balance, any other debt your family would otherwise have to pay off. Then subtract existing assets and cover: savings, investments, any existing term or employer provided life cover. Example: you earn 12 lakh rupees a year, have a 40 lakh rupees home loan outstanding, and 10 lakh rupees in existing investments. Using a 15 times multiplier, 12 lakh rupees times 15 equals 1.8 crore rupees, plus 40 lakh rupees loan minus 10 lakh rupees in assets. Your target cover is roughly 2.1 crore rupees. This isn't excessive. It's the amount that would let your family maintain their lifestyle and clear debts without you invested conservatively to generate a replacement income. This is where most people get sold the wrong product: ULIP, or unit linked insurance plan bundles a small amount of life cover with an investment component, and agents love selling it because commissions are far higher than on term plans. Here's the problem with that bundle. For the same premium, a term plan gives you dramatically more life cover because none of your premium is going toward investing. It's pure insurance. A ULIP splits your premium between a thin insurance layer and a fund that's usually loaded with charges. Premium allocation charges, fund management charges, mortality charges, all eating into your actual returns. Rough real world comparison. A 35-year-old non smoker might pay 12,000 rupees to 15,000 rupees a year for a 1 crore rupee term plan. For a similar premium in a ULIP, you might get 10 to 15 lakh rupees of life cover, a fraction of the protection, with the rest going into a fund that historically underperforms a simple index fund or mutual fund SIP over the long run, once charges are accounted for. The better approach always: buy term insurance for pure protection and invest separately in mutual funds, index funds, or whatever fits your investment plan, where you're not paying insurance charges to get investment returns, and you're not paying investment style charges to get insurance. One more thing: term insurance gets more expensive the older and less healthy you get, and pre existing conditions can make cover harder to get at all. If you have dependents relying on your income, buy term cover now, not once I'm more settled. The healthiest, cheapest time to lock in a rate is today. Quick recap: get independent health cover of 10 to 25 lakh rupees depending on your city and family size. Don't rely on employer cover alone. Use a family floater for you, your spouse, and young kids, but buy parents their own separate policy. Add a super top up to stretch your cover efficiently. And for life insurance, buy pure term cover sized with the human life value method, not a ULIP, and invest the difference separately. So that's health and term insurance, what you actually need, and why my employer covers me isn't the full picture. Together with the emergency fund we covered in the last video, this is your complete protection foundation. Once that's solid, you're ready to actually start building wealth on top of it, which is exactly where we're headed next. If you've got questions about term insurance, health insurance, how much cover you need, or anything that's still unclear, drop it in the comments. I read every single one and I'll pull the most common questions into a future video. Subscribe so you don't miss it. See you in the next one.